We're diving into a company that's right at the heart of the semiconductor industry, but that you've probably never heard of, Hong Kong Technology. So, is it a hidden gem? We're going to find out using a really simple but powerful framework. Is it big, good, and cheap?
So, what does this company actually do? Well, the best way to think about it is with this analogy. Hong Kong doesn't build the microchips. Nope, it acts as their doctor, diagnosing every possible problem to make sure each one is absolutely perfect.
So a hospital for microchips. What does that even mean? Well, when you're dealing with tech that's this tiny and this complex, you need some incredibly specialized ways to check for flaws.
Their entire business is really built on these three pillars. You've got materials analysis, which is like checking the wrong ingredients to make sure they're pure. Then there's failure analysis. That's the postmortem to figure out exactly why a chip failed. And finally, reliability analysis, which stress tests chips to see just how long they'll last. It's basically a full head-to-toe physical for the tech that runs our world.
Okay, so that brings us to the first part of our framework. Let's just forget about the stock price for a second and ask a much more basic question. Is this a big and good business to begin with? Let's see what the evidence tells us.
First up, the big question. And yeah, Hong Kong is absolutely a dominant force in its little corner of the world, especially inside Taiwan's huge semiconductor ecosystem. When it comes to these critical diagnostic services, they are the company you call.
And hey, you don't have to take my word for it. Just look at their client list. We are not talking about a small-time shop here. We're talking about industry titans like TSMC and MediaTek. The biggest names in tech are relying on these guys to make sure their stuff actually works.
So being a market leader, that definitely covers the big part. Check. But to be a truly good business, the financials have to be rock solid. So how do Hong Kong's numbers actually stack up? Well, the numbers are pretty impressive. In 2023, the company's earnings per share, or EPS, hit a record 10.81 yuan. Now, EPS is basically a measure of how much profit the company makes for each share of its stock. A high, growing number like this tells you the company isn't just big, it's seriously profitable.
And this isn't some flash in the pan either. The company is also showing some really strong growth, with its annual revenue jumping up by over 21% recently. That points to a rising demand for what they do.
But this right here, this is where it gets really interesting. This chart shows us the return on equity, or ROE. Just think of it like a grade for how well a company turns investment dollars into actual profits. And as you can see, Hong Kong's grade is way, way higher than its competitors. That signals some really effective management and a strong competitive advantage.
All right, so the evidence pretty clearly shows the company is big and it's good. So that brings us to the final, and maybe the most important question for any investor.
Is the stock actually a good deal? I mean, to put it another way, has the market already factored in all this success, or is there still an opportunity to buy in at a good price?
Now, one of the quickest ways to get a feel for this is the price to earnings, or PE ratio. It's a simple score. How much are you paying for each dollar of the company's profit? And right away, we see a clue. Hong Kong's PE is sitting around 19, which is actually lower than its competitors. That's our first hint that it might just be a bargain.
But you know, a PE ratio is just a quick snapshot. To get a more precise answer, we got to dig a little deeper with a tool that analysts call the discounted cash flow model, or DCF. It's a really powerful way to try and estimate a company's true value.
The logic behind a DCF, it sounds complicated, but it's actually pretty straightforward. You try to calculate a company's real intrinsic value by forecasting all the money you expect it to make in the future. Then you figure out what all that future cash is worth in today's money. It's a way to cut through all the short-term market noise.
So, what's the bottom line? After crunching all the numbers, this particular DCF model spits out an intrinsic value of around 250 yuan per share. Now you compare that to the recent trading price of about 210 yuan, and right there, that's the core of the cheap argument. You can see the potential upside. But hold on, it can't all be good news, can it? I mean, no investment is a sure thing, so a smart analysis has to look at the potential downsides too. So, what could go wrong here? What are the big risks that could potentially throw a wrench in this whole big, good, cheap story? And this really lays it all out. On one side of the scale, you've got the bull case, a market leader, strong financials, and a stock that looks undervalued. But on the other side, you have to weigh the risks, and they are real. This business needs a ton of cash. That's high capital spending on new equipment. Competition is always nipping at your heels, and sometimes the market just gets a bad feeling about tech, and that can drag down the stock price no matter how well the company's doing.
So at the end of the day, we're left with a really compelling case, all built on a classic investment framework. But it also raises a much bigger question for anyone looking to invest in tech. In a world that moves this fast, is a model like big, good, cheap a reliable map for the future? Or is it just a snapshot of a single moment in a rapidly changing world?